All right, James.
Hello.
Good morning.
Good morning.
How have you enjoyed your trip to Bedford?
I have enjoyed it immensely.
Yeah?
Great little town here. I love it.
You enjoy the football?
There's nothing better than a good football game on Saturday.
Drunk a lot of beer yesterday. Well,
Yes, you did. No,
yeah, you did. You were bringing me beers, man.
I will not admit to that.
Thank you for coming over.
I've loved it. Thank you for having me. It's been awesome experience. Great people here.
We're going to make it an annual trip, and we'll have an invite for you as soon as we know the dates for next season.
Awesome.
This is the final interview of the sprint, so a few things we're going to want to get into with you.
Yeah.
Firstly, there's been a lot of talk of recession. In the UK, we just missed out on recession. We had no growth, but no negative growth. Mm-hmm. And so it came out on the radio the other day. They said, we've just avoided recession. But you believe we're going into recession. It's inevitable, right?
I mean, well, in the US it is.
Yeah.
I would say in the UK it is as well. Everybody's kind of on the backside of the US, right? So, yeah, I mean, if you look at all the indicators and what all the things that I look at, which are like the yield curves, and they've been inverted for a while now, and it's a pretty solid indicator. It's pretty much 100% indicator if you're looking at the 3-month and the 2-year Treasury, and what those things are doing. But for your listeners and trying to understand exactly how that works is, so if you look at the yield curve, right, and you plot out all the yields of the treasuries, anything from Fed funds, the overnight 1 month, the 6 month, 1 year, 2 year, 5 year, 10 year, 15 year, 20 or 30 year. So if you plot those out in a normal yield curve, you'd see the rates at the front end of the curve lower than the rates at the far end of the curve, right? So longer duration assets should be at a higher interest rate.
Because it's more risky.
It's more risk. You're risking for a longer period of time, right? So in a normal environment, in a solid, healthy economy, your yield curve should move up from the shortest duration to the longest duration, right?
Yeah.
But in our yield curve currently, our Fed funds is up around 5%, and you've got the yields they're decreasing as you go further out on the yield curve. And so what does that tell you? That tells you that people believe that yields are going to be lower in the future, that interest rates are going to be lower in the future. And the reason they're telling you that is because they think that the economy is going to contract. And when that happens, you have your yields that you're looking at, right? So you look at the 3-month, the 2-year, and the 10-year are typically the 3 yields you're looking at. And you plot the 3-month or the 2-year against the 10-year. 10 years kind of like your bogey treasury. It's your benchmark, right? So when you look at the 3-month and you plot it against the 2-year, it's deeply negative, and it's been like that since last July, I believe. And so, and if you look at the 2-year and you plot it against the 10-month, it's about 60 basis points negative versus the 3-month, which is about 1.5% negative. And so it's pretty deep. It's and that's about as deeply negative as it's been since 2008. And so it's a strong indicator. Now, it doesn't mean that you're going into recession like right then. It typically goes negative. It flips negative about somewhere between 6 and 18 months, maybe 2 years before we actually hit a recession. So it kind of signals that that's the direction we're going in, right? So, but why does it? But it not only shows that we're going into recession, it kind of causes it, right? So, and I wrote a whole piece about this, and Danny, I think you read it, about yield curves in my newsletter months ago, and it not only the yields. The economy is not only affected, it's effected by the yield curves being negative. Because if you know how banks work, they typically lend at the shorter they usually lend at the longer end and borrow at the shorter end. So if those are inverted, then they are not able to make as much money, and the credit kind of contracts.
Okay.
All right. So as credit contracts and liquidity dries up, they're not lending as much. That's when you see it's more difficult to have access to capital. If corporations and companies have less access to capital, then it's more expensive for them. Their margins compress, their profits decrease, and they have to wind up either stopping certain businesses or laying off people, and it just heads us right into recession. It's a really strong and it's a very reliable indicator when you look at yield curves.
Right. Okay. So should we be referring to it as a banana? We're going to banana. Danny told me this. Tell the story of Alfred Kahn, because this is brilliant. This blew my mind.
Yeah. So back in the 70s, there was an economist who was at Cornell, and he when he taught his class, and I think Greg Foss actually had him as a professor, because he reached out to me after I wrote this. He was like, "Yeah, I had him as a professor." So, but he said, Alfred Kahn, he liked to speak very simply, and so he could communicate to his students well. And so, but he was hired by the Carter administration to be what they termed the inflation czar, right? And so, and if I forget what his title was, but it was, God, what was it? It was, and I'll look it up here so we have it. It was he's the chairman of the Council of Wage and Price Stability, right? So he was in charge of tackling inflation. And this is in the 70s when inflation was raging out of control. And he kept telling Carter and his cabinet, and speaking to the press, he was talking about how we're in a recession, we're like nearing a depression, and he kept getting in trouble for that, and like getting called out onto the carpet, and so he finally just got fed up, and he said, "Fine, well, I won't call it a recession, I'll call it a banana." And so he was quoted in the Washington Post, and he said that we've had the deepest banana we've had in 35 years, and inflation hasn't really come in yet. And so it pissed them off royally.
What tends to happen to inflation during a recession?
Well, inflation ceases. You can actually have deflation, depending on how bad the recession is. But is
that the potential deflationary moment that we discussed the other night at the?
No, I mean that's a little different. So what Jeff Booth talks about is how technology, and this is a really strong concept. It's a really important concept. Technology creates deflation. It's deflationary, right? Because if you think about it, in the examples he gives, is like you used to go and buy a camera. Well, most people don't even buy cameras anymore. The iPhone, these cameras are incredible, right? So how are you paying for that? Well, you're not seeing that anymore. It's embedded a little bit in the price of the iPhone, but then talk about calculators, right? So you used to physically, I had calculators, and an HP 12C that I used every single day at work. Now it's the regular calculator is just embedded in this phone, and you're not paying for that. It's just gone. Like you're not creating the components, you're not assembling the components, you're not think of all the supply chain and all the distribution chain that's just completely eliminated from nobody creating, manufacturing, buying and selling calculators anymore. So that's deflationary. It's nowhere in GDP anymore. It's just in your phone. So that's deflationary. So technology creates deflationary pressures. The problem is that's bad for our treasuries, right? Because we operate at such a deficit, and we've talked about this before. Our deficit is so high that we have to keep borrowing to pay that hole that we're creating every single year. We have to close that gap, and we close it by selling more treasuries and then using that capital to pay off those maturing treasuries. Right. So the problem is that deficit is growing, and our debt is growing, and so we need inflation in order to tame that, keep it from getting out of control. Why? Because, well, the higher inflation you have, it's more GDP in nominal dollars, right, without inflation. And so when you have higher GDP, then your tax base is bigger, and you get to tax those dollars and pay down that debt that you've created, that you have put on your balance sheet, right? So they need to keep creating higher and higher GDP. That it's manipulating higher, like more and more GDP in nominal dollars by creating inflation, manipulating interest rates to create inflation. And so that's what we're doing. And the problem is, though, technology is naturally deflationary. So they have to just print more and more money and manipulate the whole monetary system more in order to manufacture this inflation. It's bad for you and me. It's good for the Treasury.
So really, I mean, I think I'm starting to come to an understanding that treasuries and the balancing of inflation is really a way of just stealing from us constantly.
Yes, it's a form of silent tax.
Yeah,
and it hits certain people worse than it hits others.
But they get to control the entire market, the interest rates. I know central banks are meant to be independent.
Central banks, it's QE, it's all of it. It's all rolled into this manipulation of money.
But if you got rid of central banks and bonds, would we even care about GDP?
I mean, you want your economy thriving. It just shows that you've got a healthy economy, you've got a healthy, community. So whether it's an island or a country, and you want expansion, people are naturally productive. If you sit around all day on the sofa for a week or two, you're going to feel terrible. You're going to feel terrible physically. You're going to feel terrible mentally. Like, people like to be productive. They like to be interactive and produce things. So, but the problem is when you force people to be so productive that they have no free time, they have no downtime, they have nothing that they have just for themselves. And I'm not talking about sitting and watching Netflix, because if you're out and working for 12, 14, 15 hours a day, you don't have energy to go and do something physically rewarding for yourself, to go climbing or go running, or you just don't have that. You don't have that energy, and you probably don't have the time. If you want to spend some time with your kids, or you want to have, you want to sleep. So the problem is we've gotten into this situation where people have 2, 3 jobs. Households have 3, 4, 5 jobs. I mean, it's out of control, and they're just trying to keep up with this inflation.
Yeah, this was what Dominic Frisby spoke about in this last film I made on inflation. He referred to it, I think, as the biggest crime of our times, or the biggest scam of our times, because he said we used to have households that would live on one income.
Yeah. Back in the 50s and 60s. Yeah, and when I was a kid, my mom had to start working because we just couldn't keep up, and which is a crime, because my dad was a nuclear engineer, but he just wasn't making enough money to support all 3 kids and get us in schools and pay for college and all. It just wasn't possible.
But we've now got households with 2 incomes, or maybe 3 incomes, that can't keep up.
And they can't keep up. So, just read something the other day, and you have to take some of this stuff with a grain of salt. But there was a study and some sort of survey that said that people have started skipping meals in order to make mortgage payments or make rent payments.
Yeah,
that's a problem. That's an indicator of what we're talking about.
They've pushed the scam too far.
Yeah.
Man, your dad was a nuclear engineer, nuclear power engineer.
Yeah, so he designed steam turbines, steam turbines for nuclear reactors, and they were in submarines. So he worked for GE, Navy Nuclear Division, and so their only client was the Navy.
So what would he make of all these plants being decommissioned in Germany?
No, he would be disgusted.
Fucking mental.
He would be disgusted. This is just insane. I mean, it's literal insanity.
Yeah.
I mean, they were perfectly productive, and they're closing them down. And people don't understand. We don't have to get into a nuclear discussion, because it's going to be looked at. They're going to look back at that as being one of the largest mistakes they've ever made on energy policy in the history of Europe.
Right. Back to recessions.
Yeah.
Are recessions healthy themselves, though? Should an economy have recessions? If we're going to have expansion of the economy, do we not need to have recessions? And is it not good to have a period where we can wipe out some businesses, wipe out some jobs, the ones that aren't really? Because I always think the strong businesses will survive.
Well, I mean, think about it. So why are weak businesses surviving? Well, they survive and they thrive even though they're weak businesses because we've had ZIRP, zero interest rate policy, for so long. And it's just this free capital. And access to free capital allows bad actors and poor management, poor risk management to actually live and or keep going. And that's the problem. So in a normal economy, sure, you're going to have ebbs and flows. I mean, it's organic, right? But in a normal community, but when you manipulate this much, those ebbs and flows turn into peaks and valleys, and they just get larger and larger.
And so you think we might be heading for quite a deep recession?
Well, it's hard to say. I mean,
potentially.
So the problem is we just don't know how we haven't seen the effects of all these rate rises. Why? Because we've raised the rates so quickly, so rapidly. And I mean, I don't know if you can pull it up, but I've got one chart that I showed Danny earlier today. That is just the rate of the rate rises that the Fed has done. Yeah, I mean, like,
what's the time scale on that?
Look at that. It's just the middle of last year. We just started raising rates. Look at how quickly we've raised those. And so the problem is we haven't had time. Look at back in even in 2016. Look at how we started raising rates, and it's just a stair step, and that's kind of normal,
Right. Okay.
So you start seeing some of the effects of So if you look at that in 2016, you could start seeing the effects of those raises in 2018, 2019, 2020, right? But look at how long it took for those to come into effect, where we started decreasing rates. This is before the pandemic. And, you started seeing those. Look at how long it took. But we are just raising these things. It's a rocket ship, I mean, it's not healthy.
And so when you look at 2004, that's what really triggered the global financial crisis, because the rates went up. People couldn't afford their mortgages. People who'd had 100%, 120% mortgages. I was reading about multiple homes. They were trying to flip them.
Yeah.
And I guess
some of that was just poor policy around the mortgage market.
Yeah.
And so, most of that.
But do you think we could be heading to could this have a housing crisis wrapped in it again?
I don't think it'll be like that, no, because it's not centered around housing.
Right. Okay.
The problem with this is all that leverage is embedded in what we're seeing in the banks, and we're seeing in now. I mean, the commercial real estate market now it's different than housing. I mean, that's embedded in these small banks. The small banks own all this paper, and so that could be a problem. That could be a major problem. But what we're not seeing is the effects of all those rate raises on all these companies that are now, they're having to refinance notes. They're going to have to try to borrow capital. They're trying to get lines of credit, and the lines of credit are way more expensive. Now you're seeing individual balance sheets, individual credit card holdings, and the balances are just skyrocketing, and the rates are up over 20% average. That stuff is going to start. Those birds are going to come home to roost, and that's the problem. And we haven't seen that yet. So my fear, and this is so. Look, I don't know. I mean, I really don't know, Peter. But I feel there's a high probability, and I think of everything in probabilities and likelihood, and I think there's a high likelihood that we hit a pretty healthy recession here. And for the reasons that we've talked about, all the leverage, the low interest rates, skyrocketing higher, and then the inflation, people getting squeezed. It could be a powerful drawdown. So we could just see a watershed moment, and that could come in the form of a credit event. And I'm talking about one that isn't saved by the Fed and the Treasury, one that we don't have this new little BTFP program that comes in and saves and shores up the banks, and then we're okay and we can move along. And that's just a plug in the hole of this big wall that could break. That dam could break, and I don't know what that could be, or what that will be, but there's a high chance of that. there's much higher than non-zero chance of there being a credit event.
And when you say a credit event, do you mean could be some large bank failures, and they'll just let them fail?
It could be like Deutsche Bank, well, they can't let Deutsche Bank fail.
Okay.
Right. So you've got certain banks that are protected. They're protected under the G20, and they're on a list, and they're too big to fail.
Okay.
If they fail, they'll take down the whole financial system. Why? Because of contagion. There's counterparty risk between the banks. If one fails, this one might fail. It might take down the other one, and that counterparty risk is too large, and the ripple effect from that will reach just about every single corner of the financial industry, and it'll just collapse.
Right.
That's their thesis. So they can't let any of those collapse. Jamie Dimon is safe. So is his job. So is his money. So,
but outside of those banks, it could be some other banks that are allowed to fail, will fail. They will allow them, and that could have some contagious spread.
It could be a non-financial institution that fails. It could be a very large company that has counterparty risk that we're not thinking of that fails. We just don't know. We don't know where there's some dark spots in there that we're not aware of. Private equity and venture capital. And Jeff and I were talking about this weekend. There are books that are just not marked properly yet. These companies, these venture capital firms, they've got these portfolio companies that are struggling to raise capital, and especially in this environment. And if you can't raise capital at the valuation you did last time, you have what's called a down round. And if you have a down round, then the venture capital firms have to mark those books down. And so that's just one spot where we aren't seeing that. And the same thing with the private equity firms. As interest rates go up, cost of borrowing goes up, cost of capital goes up, right? So the margins compress. The firms, these companies are not making quite as much money, and so they shouldn't be valued where they were last year, perhaps. And those marks, a mark to market, which is done by hand by these private equity firms, that has to be fixed. So, and when you go in and you mark to market these companies, then the profits are a lot lower, and that's just yet another spot. We just don't know.
And that could trigger a lot of people taking interest in these other companies and expecting everyone to reprice.
Sure, yeah. And I mean, if you can't get capital for one of these portfolio companies, it might you just don't know where that's going to ripple out. It's difficult to say.
Could be Twitter.
And it could be, not funny, but could be. It could be Twitter. That's a lot of debt.
44 billion?
Yeah. And the problem with that, so talk about that, actually, I think I wrote about this too, but the problem with that is that these banks are saddled with that debt. It's called they're hung with this debt.
Right.
So what happens when you do leverage buyout, banks they'll basically lend you their balance sheet to do this buyout, right? And they'll say you can park that debt here, that you're going to go take over this company. You're going to make some changes. You're going to make it profitable or more profitable by these changes, and then you'll be able to pay off this debt. And what we're going to do is we're going to syndicate it. We're going to underwrite it, which means that these banks will take that debt onto their books and then sell it to their customers, right? So they'll sell it to the private equity firms, they'll sell it to high net worth individuals or family offices or endowments, and they'll sell it to them, right? But in Twitter's case, they took down that debt and they're hung with it. They're hung with billions and billions of dollars with this debt, and it's sitting on these banks' books. So Twitter goes under. I'm not saying this is going to be the event. This is just one of those things that if Twitter goes under, well, these banks, and maybe one of the smaller banks, it really takes them, it hits them harder than we realize, and it's a problem. So you just don't know, and that's just yet another spot of leverage in the system. So
in your mind, are you partially preparing for a recession? How do you prepare for a recession?
Yeah. So well, you want to have your money in safe assets. And so I have a large percentage of my net worth in gold and silver and hard monies. And I also have capital in Bitcoin, obviously. Now, that said, look, if we hit a recession, we have a credit event. What happens is, we have a saying on Wall Street is all correlations go to one, which means that everything sells off. And so because what happens is you literally step into the trading floor. And it doesn't matter if you're a hedge fund, if you're a large investment firm, whatever it is, and you step in and you see the market drawing down, you just say, take 20% of everything off the books. You don't even have time. You just take it all off the books. I don't care if it's Apple stock. I don't care if it's Philip Morris. I don't care if it's a bond. I don't care if it's gold. Just take it off the books. And so you have this drawdown, and it's steep. But we were just talking about all the leverage in the system, the treasuries, and there's just too much leverage in the U.S. system. They can't let the market draw down too deeply. We can't go into too deep of a recession. And everybody knows this. They've been conditioned to it. And this is the QE moment where the Fed pivots and they step in and they print. And everybody's expecting a face melting print. And you saw it in 2020. And I feel if we have a credit event, it'd be more like that, where you just have a straight down, everything goes correlated to one. We have a significant drawdown. It could be 15%, it could be 30%. I don't know if you have a major credit event. But the Fed will come in, the Treasury will come in, they'll print, and they'll shore up the market. No, we've got this, don't panic. And they'll print so much money that your eyeballs will melt. So it'll be the face melting print, okay? If you just have a strong drawdown because of a recession, well, they will step in. Well, we know they'll step in. They've done it before, repeatedly, and the Fed's been saying it. Powell said it a number of times in his press conferences. He said, look, what we can't have is inflation get out of control. If we have inflation get out of control, that damages the credibility of the U.S. Treasury and the U.S. dollar, and it could lead to hyperinflation. So superinflation, serious inflation leads to superinflation, which leads to hyperinflation, right?
Hold on. So what is superinflation?
I'm just.
Oh, you're making it up.
Yeah. So,
I was like, we don't know.
Hyperinflation is like, what we're seeing in our economies.
Yeah.
In the UK, over 10%. In the US, it got up to 9 and change. But when you get to like superinflation, it's really steepening. I feel like superinflation is inflation that is severely damaging to citizens, yet it's not hyperinflation yet because it's not 50% month over month, which is a ludicrous measure by any standard. But anyways, what you can't have is you can't be accelerating into that, and they know this. So they've got to calm down inflation. They're in a really tough position. We've got so much debt on our books. Every single time they raise rates, we're reissuing more debt at a higher cost to pay down the last debt, which means that our deficit grows, which makes it more difficult for the Treasury to dig out of this hole. And we know it's unsustainable. They printed a chart, and I wish I had given this to you. There's a chart on one of my newsletters, and you
can find it.
Yeah, find it. Which one?
It's the chart that shows it's the.
Do you know the newsletter?
In my pinned newsletter.
Okay.
It's the chart that shows the Treasury and admitting how bad debt to GDP is going to get. And so what they did here is they did this report, Peter. Mm-hmm. All right. They went, and this is the Treasury, the U.S. Treasury. They did a report, and they're looking at it's like a 2021 report card. Like, how are we doing? And and they go through and they're saying this is how much we're spending, this is how much we're making. And the problem is, look at
holy shit.
This is a report that the U.S. Treasury put out, and hat tip to Lynn Alden. She found this before any of us did, and she kind of alerted me to it. But they're showing here this just how much it's not funny. This is ludicrous.
Yeah, but it's stupid funny.
But this in this report, the subtitle of the report is an unsustainable fiscal path. That they literally put that as a subtitle over the report. I mean, for the whole world to see.
The historical high was 106% post-World War II. Understandable.
Yeah. Yeah.
Yeah.
And here we are.
And this is the expectation. It's a pretty...
And for anyone listening,
would
it's
have
projected to get to like nearly 700%.
Well, here's the thing, though, and what's also crazy about this is that this is actually pretty optimistic, right? So if you look at the U.S. Treasury, so the CBO puts out a report every. There's so much we can talk about, but the CBO puts out a report every year, and actually it's periodically. So last report they put out was last March or last May. They just put one out a couple months ago. And it talks about the deficits, right? It's basically it's the CBO, the Congressional Budget Office report. It talks about the balance sheet of the Treasury. Of course, it's all deficits, right? And so what they're expecting this year is to have a deficit of about $1.4 trillion. We can walk through the math. I think we walked through it with Greg.
Hold on, that chart, they're already at 1.4 trillion for the year. You know, the US debt clock.
Mm-hmm. Yeah. What's happened since last? So their fiscal year is in October.
Yeah.
So over the last 6 months, we've actually been running a deficit over $1 trillion in just 6 months. So this fiscal year, we're running a deficit that's $2 trillion, right? So that's what they're projecting. Okay. So that's the very optimistic view, but they've been putting out numbers and their deficit numbers, and if you add them up from October to now, it's $1.1 trillion. So they're on a run rate of over $2 trillion for this fiscal year. Jeez. Yet on that chart, what they're assuming is $1.4 trillion. Now remember, everything is exponential.
Well, that was my problem with that chart. It was kind of like a straight line.
Yeah, it's not gonna. It's gonna do this. Yeah. Yeah, so that's the problem.
But they'll never allow it to go that far. I mean, Lynn Alden always says that the event horizon for debt to GDP is 135%. Once you go beyond that, you can't get out of it. And so
you can't get out of it. That's it. It's over. Yeah. It's over. It's like we're in a debt spiral. Now, okay.
Yeah.
Before your listeners could, they
panic.
This can go on for a very long time. All right, this can go on for a very, very, very long time. First of all, look at Japan. Japan's at a debt to GDP over 250%. Yep. They own more of their own bonds than anybody else in the world. They own over 50% of their own debt, the Bank of Japan. And they're still going, and nobody's even really talking about it. Okay, so this can happen, and the U.S. dollar and the U.S. Treasury, I mean, we have the benefit in the U.S., and we have the benefit of being the global reserve currency and the global reserve asset, right? The dollar and the Treasury. So we can do this for a very long time, but what we can't do is get out of it. And eventually it will collapse. I don't know when. I don't know if it's in 2020 or 2100, like that number is not going to be 700%. That number is going to be so much bigger than that. But I don't think we get to 2021 or 2100. Sorry, I don't think we get to 2100. I mean, I don't think this can last until 2050. That's like 30 years, but it's not going to happen tomorrow. This could go on for decades. So,
do you think the Fed's going to drop rates?
This next meeting? No.
Yeah, they're going to go sideways.
I don't.
You think they'll rate?
I think they're still on. I think they're still full steam ahead. Another 25 basis point raise.
Okay.
So, but I'd also think that that's the last one. I think then they can back off and say, "See, here's the thing: is that I'm waiting to hear the Fed say that we're above a neutral rate." Meaning it's constrictive, right? Mm-hmm. So if you're below a neutral rate, it's expansionary. But if you're above the neutral rate, the Fed funds rate, that means that the cost of capital is causing constriction in the economy. But we haven't even been able to see it. So the problem is when they turn and they realize that, oh, this is like the economy is really starting to not just cool down, like it's wiping out, then it's going to be too late. And that's the issue. So that's why you're watching Wall Street and you're seeing the Fed funds futures, and they're predicting that we start lowering rates this year because the economists and the investors on Wall Street are thinking we're going to hit a spot here with Fed not just pauses, but has to really quickly pivot, because it's going to be apparent that the economy is not just going into the tank; it's going to be flushed, and we're nosediving. And so I think that's a pretty high likelihood.
What's the time spell for that time span potential?
I mean, it's impossible to tell.
But I'm saying, could it be multiple years away, or are we talking probably next year?
I think it's in the next 6 to 12 months.
Right.
Now,
okay.
But going back to your original question, I want to make this point. That's why I personally hold a lot of cash right now. Everybody talks about cash is trash, and and we're talking about the fact that if you hold on to cash for a long time, well, you're losing purchasing power because of this high inflation. That's a problem. However, in these periods where you're of uncertainty, you want to hold some cash because you want to have some dry powder ready for when we do have a drawdown, because that's when fortunes are made. So, period.
But it's funny because I ask it thinking, well, how do I kind of protect myself, and where are the opportunities? But I also fear scenarios where, as a person, you get wiped out.
Yeah.
There's a personal contagion.
Mm-hmm.
Did I tell you where that gradually then suddenly came from?
I think you did, but I can't remember.
What's that?
Gradually then suddenly. A lot of Bitcoiners
remember
that.
Yeah.
Well,
I was Hemingway.
Oh, Hemingway, yeah. It's about going bankrupt.
Mm-hmm.
It's gradually then suddenly. I just fear a scenario like suddenly there's no, like the marketing budget's dried up this year. That could have been bad for the podcast. And then I can't pay my mortgage, and then Bitcoin has a massive drawdown. And your entire life changes. And
and then Bitcoin and everything sells off. Yeah, and you have some sort of margin call, whether it's literal or something, because you're not making as much money for the podcast because the marketing has dried up, and the marketing budgets have dried up. Well, that could cause other things, right? So,
or there's massive inflation, and the cash you have is destroyed.
Yeah, well, I mean, I don't see us getting to a spot in the West here with hyperinflation in the next year or two. That just doesn't. I don't see that. Is it possible? It's a non-zero chance. Well, I mean, like you look at that Treasury chart. It's obviously going to happen at some point.
But you think about the craziness of that. It's like, I don't think we will enter hyperinflation into the next year or two. It's not like, we're never going to have hyperinflation.
But even that it can possibly be part of the conversation is crazy.
Yeah. I mean, and again, the US dollar would be the last one to hyperinflate in my opinion, or one of the last. I mean, maybe the Swiss franc or something, but it'll be one of the last.
Yeah. So I've been talking to Danny a lot about buying gold. I've really been thinking about it. I talked to Larry about it this week. I was thinking of doing it with cash I hold, just having it in gold. To me, it's still cash. Yeah.
Yeah, some of it.
Yeah.
And again, you're going to have that moment where the gold could get hit too. But I do believe, I believe that gold has, it's a strong store of value over a long period of time. It's been like that forever. So, it's safe over a long period of time for sure. But again, you just want to, I think for me personally, it's smart to have some cash too. I wouldn't have it all in gold.
So a bit of cash, bit of gold ETF, some physical coins.
Physical backed ETF. That's important.
Yeah. What was the one he recommended?
I can't remember.
PHYS.
Yes, that was it.
Yeah, that's the one he likes.
Have you always been a gold bug?
No. This last couple of years, sound money has become absolutely abundantly important to me. And so that's why I love Bitcoin. It's not ready for prime time on the stage with the entire investment community. I mean, it is ready.
They're not ready.
Bitcoin's ready, but they have no idea. They're just not, they're clueless still. So, and that's the problem. But once they clue in, it's a different story.
Well,
And so for long term, I mean, long term, you just buy Bitcoin and just put it away.
Yeah, of course.
Just put it away.
It's a real balancing act of where to put your money.
Yeah, because you have short-term needs.
Yeah.
You have a mortgage. You have to pay for, you have to pay employees. You have to, I mean,
Think of the kids. I have to think of them.
kids,
There's a lot to think about.
Yeah.
But I still think the fact that we're discussing a potential future hyperinflation event in the here in the UK or in the US,
it's
a lot. Yeah.
It's mind-bending. Yeah.
because when you see it happen in Venezuela or Zimbabwe, you look at Chavez or Mugabe, and you're like,
it's because of a dictator.
Yeah.
It's because of a poor economy. It's because no, it's manipulation.
oh man. So before, because I want to talk to you about the BRICS nations as well.
Yeah.
But can we just talk about unemployment as well? Because this is another thing that me and Danny were trying to rattle through this morning, is that there's high employment. There's lots of companies who cannot employ people. I was chatting to a lady last night who runs a recruitment firm. She said, I cannot get temporary staff. Yet we're heading into recession. So in your head, you're like, what? How can there be such high employment?
It's head scratching.
Companies are doing well, and we're heading into a recession.
Well, and that's the thing, is that people talk about that. The Fed talks about it. They say, "Oh, look, employment's still high." And they talk about how we've got to bring employment down. Basically,
It's mad. That
it's
isn't
mad.
it? We want
people unemployed. Yeah, it's sickening, is what it is. But the thing is, when you look at the employment, rate and you plot it against recessions, and you can do this through the Fed. When you do that, you get this you get this lightning bulb moment when you think, and look at it. You realize, employment starts to tick up, but it doesn't really spike until you're actually in the recession. I mean, it takes the moment for you to get in the recession for people to lose their jobs. So looking at that unemployment is actually a lagging indicator. So, and that's problematic. So, people keep talking about, but unemployment's so low, Look at right before each recession. It ticks up a little bit and then explodes. Ticks up a little bit, explodes. One after another, after another, after another.
Yeah, 2020 is a hard one to judge because it was such a weird scenario.
Yeah, you take that out. It's an anomaly. That's a tail event. But if you look at 2010, but that's interesting because we had so much lead time going into the housing crisis, right? But look at each of them.
Every single time.
It's mind-boggling, right? So, and so when you hear people talk about, but everybody's employed, look, everybody was employed in every single one of these recessions right up before. And then everybody lost their jobs.
But what is the correlation there between high employment and high employment pre-recession? Is it because the inflation has driven this? And
inflation drives all of them. The expansion and then or easy money, cheap money in the last number of recessions that we've had. But then, if you just walk through the mechanics of it, borrowing becomes more expensive. So everything's more expensive for the company. The company's profit margins decrease. They decrease to a point where they have to start laying off people. But their profit margins are decreasing leading into this. And then all of a sudden they're like, oh, we got to lay off a bunch. But it happens across the board. So if Microsoft's or Apple's profit margins are decreasing, it doesn't just affect Microsoft or Apple. Think of all the suppliers that go and that create all the components that go into all those products. And then think of all the distribution, that's all the manufacturing, it touches everything. So when Apple goes into a recessionary mode and they end up selling 50% fewer laptops than they did last year, that's a problem.
And we've seen massive layoffs in the tech sector.
We are seeing massive layoffs. They're starting to see, and so that'll start rippling through.
I mean, how many people have Meta? Have they rebranded back to Facebook now?
Have they?
I think they might have. I'm sure I read that, or maybe I
they laid off loads of people.
tens of thousands.
10,000 employees. Another 10,000
Another
employees.
10,000. And Microsoft laid off a bunch of people. I don't know if I heard about any layoffs at Apple, but there's a lot of Google. I mean, even Google. Google was such an interesting one. They're clearly under massive threat from AI. We're not going to get into this now.
No,
It's a whole other subject. But there's a real. So, do you remember? Do you remember pre-Google?
And there you have. There's something interesting, right? So you have AI coming in. Man, AI could not have come at a worse moment, right?
Yeah.
I mean, we're not at true AI yet, but
Do you remember pre-Google?
Yeah, I remember like Ask Jeeves.
So there was.
But it wasn't, not
No,
pre-Google, there was just
pre-Google.
competitors.
There was a. Do you remember Alta Vista?
yeah,
That was the
I
one.
don't
That
remember
was
that.
the one everybody used. It was brilliant. It was a brilliant search engine. And then Google came along, and the first time you used Google, you're like, oh, the results are better, and you just stuck with Google. The results were just better. But there's never been a reason to go away from Google, apart from now with AI, you can get better answers to specific questions. Danny's regularly using it. He fact checks during the show, sometimes using ChatGPT because the answers are better. It's a massive threat.
yeah, it's a massive thing. It's not fully there yet. Also because it's the inputs are controlled.
Yeah.
So, but I have to go and fact check some of the stuff I get from ChatGPT.
Definitely. But what you can do, you can ask it much broader questions
Yeah.
and then ask for citations on the results it's given you. And so it's sometimes quite useful. Like you can ask it a much more generic question. Like we asked for it to summarize a chapter of a book in an episode.
Wow.
And it gives you like a perfect, well, I've not read the book, so I'm assuming it's a perfect summation, but so it's useful when you need a much broader set of
Interesting.
inputs.
Yeah. Interesting.
All right, let's talk about BRICS nations. Seen a lot of growth and a lot of growth in coverage of the BRICS nations. We've seen other countries wanting to join them.
There's a lot of chatter about it.
Yeah. So part of me thinks it would be healthy to go into a
Yeah.
multipolar world. It's probably good for Bitcoin.
Well, I mean, healthy. Yeah. I mean, it could be painful for the Treasury. I mean, first of all, let's walk through what it is, right?
Well, can I just say why I think it's healthy? I think the US has too much control over the other countries. Like other countries suffer under
smaller
US,
countries
smaller
really do
countries.
suffer. Yeah.
And it's, I think the chance to break away from that. I mean, we made the show with Alex Gladstein about economic imperialism. I mean, it's not good. And for other countries to have an opportunity to break away from that, I think could be a good thing. Bad for the US, good for the rest of the world.
Yeah.
I don't know if ultimately bad for the US is long-term good for the rest of the world because of the nations that are part of
That's the
BRICS.
problem. Is how quickly, how badly.
Yeah.
So BRICS for your listeners it's a cooperative of countries that have agreed to band together to kind of create their own in their own trading economy, right? So they're talking about creating their own currency. They haven't yet because you need to have somebody's currency in there that you can trust, or you create one collectively, right? So the nations are Brazil, Russia, India, China, and South Africa, right? So you put all those together, you get BRICS. And that's what they're trying to do. And you're hearing a lot of chatter about, hey, we've got to pull away from the dollar hegemony, right? So we've got to. It's just too powerful. Well, I mean, look what happened last year when Russia stepped over the line, attack Ukraine. Well, the answer from the United States was, well, we're going to seize their treasuries and we're going to cut them off SWIFT. Okay, so
And maybe blow up a pipeline.
and maybe
Maybe it was them. Maybe.
there's only a few operatives around the world who could have pulled that off.
It wasn't me. It wasn't Danny.
Danny, where were you?
I was in that little stretch of sea between
Ask
Norway.
ChatGPT who blew up the pipeline. No, so
do
it
it.
won't know because
This data's too old.
Too old. So it happened too recently. So so that's what you're hearing. But now you're hearing of other countries talking about it, and Iran has just applied. Saudi Arabia's talking about it. So what they're looking for is they're really looking for a way to settle trades in non-US dollar denominations.
Do you think this is mainly a political move, mainly an economic move, or it's just both?
Both, definitely.
Right.
for instance, China just settled a very large LNG trade, natural gas trade, with United Emirates, and it was in yuan. It was in Chinese yuan. So it's real. They're doing things, or it's happening. If you put together the BRICS nations, their GDP is actually now it's cresting the G7 nations.
Wow.
So it's actually So I had seen a chart on that very recently about it's actually just crested it. So
when they settle the trade in the yuan, does that mean that country holds that yuan, or do you think they're still sending it back into dollars?
No. Well, no. I think that they're. I mean, look, they're probably selling it right back into their own currency, right? So, but
hold on. So is the GDP of the G7 is falling?
Yeah.
That doesn't make sense.
As a total share.
Oh, as a total share. This is a percentage.
Yeah.
Okay. I was going to say that didn't make any sense. So it's about crossed. Oh, it's crossed already.
It's crossed already. So it's pretty interesting. So it's real. I mean, could it? So the real question is, like, what everybody wants to know and what everybody's trying to figure out is could BRICS cause the U.S. Treasury to no longer be the global reserve asset, meaning the U.S. Because what happens is you want to hold treasuries so you have an easy way to get dollars, right? Because if you hold your own currency and you need to constantly move that in and out of dollars, then you're at risk. But if you hold treasuries, you're not at risk. If you know you're going to need dollars, you're naturally hedged by owning treasuries. Does that make sense?
Yeah.
All right. So that's why the U.S. Treasury is the global reserve asset, because all these countries need access to dollars quickly without the interest rate, without the currency risk, the FX risk. Yeah. So the holding treasuries. So if they can break away from holding treasuries and use their own currency, then they don't need to worry about propping up the United States and propping up the U.S. treasuries. They can sell their treasuries and use their own currency.
What would UAE be holding? Would they be holding, like,
that's a good question,
Chinese treasuries?
I don't know. I don't know what their balance sheet looks like, to be honest. So, but interestingly, that's the question: is could this eventually cause the collapse of the U.S. Treasury from being the world reserve asset? Well, what would be the global reserve asset? Well, the obvious thing would be gold. Yeah. Right. Why? Because it's been around for centuries. It's trusted as a store of value, and so it's not surprising that you're seeing huge amounts of gold being bought by all these countries recently, right? And so,
you think that's why they're buying ahead of this?
Because both Russia and China have bought a lot of gold.
They bought a lot of gold, and it's all started happening. It really started to flip. Like gold was net being sold by sovereigns and central banks, all the way up until the Great Financial Crisis, and then after the Great Financial Crisis, all these central banks started buying gold, and so it kind of flipped, and now it's gone positive. And yeah, there's the chart. So Russia, China, India, Turkey all accounted for the bulk of those purchases that we're seeing, and that's the interesting part. So
why do you not think we've seen such a massive rise in the price of gold? Because this is like a high indicator.
Because gold is manipulated with paper and derivatives.
Well, that's what we've been told, but how? I've never really fully understand how it's being manipulated.
You could sell paper, create paper around it that you don't really have attached to any reserves that are in vaults, right? And I don't know how Goldman is marking their paper, but they're short massive amounts of gold, and so it's just a way for them to hold the price down. It's like the Bitcoin future. We just short the future.
Why is it in Goldman's interest to keep the price down?
That's a good question. I mean, that's a probably a much deeper conversation than this than what we're pointing to here. But you know, you don't want gold to usurp the U.S. Treasury, right? You don't want that. You want the U.S. Treasury to be what everybody holds.
Right.
So you want the Treasury to be if you're a U.S. centric business, if you're a U.S. person, if you're the U.S. Treasury, that's what you want. So, and that's what this is kind of threatening, right? So this is threatening. Is it threatening it really yet? No. I mean, the dollar it's a massive share of a means of exchange across the world, right? So even if you look at it's been falling. It was in the 70s, and 72% of all transactions were done in dollars just 10 years ago? It's fallen. It's under 60% now. It's like 59%. But it's still, there's nothing near it. There's nothing close to it. I think the euro is at like 20 or 21%. So it's not even close. So the dollar still has a chokehold on the entire world. Let's make that clear. It's not, and it has to do with a lot of different things. It has to do with the fact that treasuries are the reserve asset. Okay. It has to do with the petrodollar, transaction based, energy transactions are by and large done in US dollars around the world. Okay. It also has to do with the fact that countries who cannot lend in their own currency, that have hyperinflated before, that don't have the ability to issue their own debt in their own currency. They have to issue debt in the U.S. currencies, right? They have to issue debt that's based in U.S. dollars. So the euro dollar market is massive around the world, okay? So it's so deeply ingrained into the system. And this is why we say U.S. dollar would be the last one to hyperinflate. It's in everything.
But you were talking earlier about like a massive credit event. Presumably, if massive institutions like Goldman are short gold, a gold price running up could cause that could be one of the triggers. If they have to mark their books correctly,
I'm not going to predict that, but I don't. Yeah, I mean, if gold doubled or tripled, that would not be good for them.
Interesting,
right? So that would be a very bad moment for them. So yeah, I mean, it's in their interest to keep issuing paper and keeping the price down. So now I'm not. Let me back up. I haven't studied Goldman's balance sheet. I don't know exactly what they hold. I don't know that, but I've just heard recently that they hold a massive negative derivative position in gold. So
so if the BRICS nations form their own currency, do you think it would be like a basket currency?
Well, so that's the problem, right? So none of these countries have really been trustworthy to anyone or each other. Yeah. Not that the U.S. is, but again, the U.S. has the chokehold. Are you going to trust China let's say that you want to have a gold-backed yuan? Are you going to trust that they have the gold in the vaults that they say they do? Are you going to send in teams to audit them? Are they going to allow that? I don't know. I mean, and how much gold would they really have to buy? That's a lot of gold, right? That's a lot of gold to back the yuan. Another thing is look, the Chinese economy it's not a tremendous economy. They have their own debt to GDP problems. I mean, their debt to GDP is in the hundreds as well, 350, and that we know of. We don't know exactly what it is, and their whole economy. People in China, their savings is in their real estate.
Yeah.
So their homes that's what when we talk about, well, what should I buy? Gold or stocks? They don't own that stuff. They own their homes. That's their net worth. And so all their net worth is tied up in this real estate market. And the real estate market is not good out there. It is massive problems we started seeing last year. So, I mean, where are you going to denominate it? There are problems with it. So as much attention as excitement as there's been around BRICS, there are deep structural problems with those countries already. So it's not like something they're just they're going to band together. The dollar's no longer going to be number one. We're going to have a few currencies. They'll start doing trades in yuan or their own currencies like we're seeing happen. But this is a long tail event. So,
Yeah, I mean, you need a single currency for it to be competitive to the dollar. So is it? That's why I ask. Is
good
it?
question.
Well,
Good.
so
'Cause
yeah.
it can't be gold. The gold is not a means of exchange, right? It's not good for trading, for barter.
No,
You can't. Yeah, I can't say, hey, Peter, I really like this house. I'm going to rent it from you for the summer. I'll give you a couple of gold coins. What?
Yeah.
Like it just doesn't work that way,
Yeah.
right? So, or
Although
I'm
you
gonna
weren't
buy
sure
you
how to get gold.
even worse.
Yeah.
I mean,
do you want
a
to?
cup of, you want
You can have it for the summer.
a cup of coffee? What are you going to do? Scrape off some? I mean, like what? So it. However,
I've heard about this invention.
however, there is a new invention. So,
But before they get to that, before we get to the Bitcoin, is there a way they can create a, I don't know, like a central bank of BRICS where they have their own currency for it? Because what I'm thinking is, what are the reasons to do it? Is it
like the European Union, it'd be like that.
Yeah.
But who are they going to borrow from? China? Like who are they going to borrow from?
Yeah.
Russia? The European Union borrows from Germany. So who's going to be
Yeah.
that centerpiece? Who's going to,
So do you think it could be something like Bitcoin?
Yeah, of course it could be. It could be. All right. So why is the Bitcoin? I mean, it's not conspiracy. It's just why is the Bitcoin hash rate up over 350 now? What is it at? It's 300. I heard yesterday it was at 355. I mean, this is
Yeah, it's above 350.
Keep it up on the.
Yeah.
okay. So what percentage of that is over the? Look at that rise in hash rate. Who is plugging in miners? Now, I've heard a number of theories on this. Part of it is that the S9s are being retired and the 140s are being plugged in. They're just much more efficient. They drive that much more hash. Okay, that's one thing. Another thing is you're getting people who are plugging in miners ahead of this move in Bitcoin, right? Because look, just think of the function of it. When Bitcoin's price runs, it's very difficult to get mining set up. All right, let's back up. If
Industrial scale.
if Bitcoin's price falls, just turn off the switch.
Yeah.
Unplug that miner. If Bitcoin price rises, okay, and you've already got all your miners plugged in, well, you have to source energy, you have to source huts, you have to pull energy to the huts. You've got to
It's their
source and
large
plug in miners.
infrastructure.
It's much more difficult to chase, right? So maybe what's happening is that some of these 140s are getting plugged in, and they're trying to front run the halving and get as much hash up there as possible now, especially before Bitcoin's price runs. Maybe there's a massive amount of miners being plugged in China and Siberia. That's a possibility. I don't know, but it would seem to make sense that there's some sort of state player involved. And if it's not, well, it's just a whole lot of miners being plugged in. But it could be Russia's trying to load up on it. You've heard them rumble about accepting cryptocurrency as payment for their energy. So,
And how do you think they would deal with the volatility, or does that not matter because they would just settle their end? I think the difficulty is how much liquidity is required. You could only do small trade. You can
how is Bitcoin done against the ruble? Right?
Interesting. Yes, have a look.
Yeah. That's what they're thinking of. They're not thinking of what's Bitcoin done in the price of the dollar. What's it done in the price against the price of the ruble?
But I'm thinking, what's a trade in? I don't know. Are these are tens of billions, these deals, when they do an oil deal?
They're billions of dollars.
Yeah. So,
definitely.
But if if you'd settled a trade by $1 billion, and it was in Bitcoin first, so you got to accumulate the Bitcoin to be able to settle the trade, and then So I think we're
so you're talking about something that's way out there.
Yeah.
This is not something that's going to happen this year.
But they could start testing small trades.
Sure. You can start testing small trades and see how it does. I mean, look, the likelihood of all of this it's still low in my opinion. I wrote about it because there is some game theory around it. You know, there are scenarios that we need to probably start thinking through. And that's the thing that, do I think that BRICS alone would topple the U.S. the U.S. Treasury today? No. However, there are things that this could accumulate. I call it BRICS plus, and what I mean is you have Iran and Saudi Arabia join, so BRICS, and then plus, meaning other countries start to join, right? So we don't know who those would be, and so, but when you get enough together, banded together, and you've got enough of economy, what they need is they need enough trade with economies that are both net exporters and net importers, right? So you need countries that have raw materials that can export to countries that have manufacturing, to countries who are net importers and buying those goods and services. So it's got to work. Where the U.S. has the benefit of, I mean, we can buy and sell in dollars to all the economies, you know. So the economy's got to it's got to get to some sort of critical mass. Let's say it did. And let's say that Bitcoin does get to a critical mass where it is possible to have these massive transactions daily in energy or in goods and raw materials. Well, now you're getting into a spot where it may be too late, but that's now the U.S. has to make a decision, you know. Do they buy Bitcoin? And so this is the game theory, right?
This is the game theory.
Do they buy Bitcoin and start backing the US dollar by Bitcoin, or do they not? And does the BRICS denominate in Bitcoin, or do they not? Do they back their currency? And that's the game theory. Again, far out there. This is far out there thinking, but why not walk through it? Because it's very, it's on everybody's mind. Let's talk through it, So if BRICS does, if they buy Bitcoin and they back their currency by it, right? And the United States also does, well, the Treasury probably remains as the global reserve because it's backed by Bitcoin. It's backed by something that's decentralized. It's not inflationary. It's easily transferable. So all those things, right? But if the BRICS does it if the US does it and the BRICS doesn't do it, well, the US Treasury is still going to remain the global reserve asset, right? Mm-hmm. Because it's back. The US dollars, I'm sorry, I'm conflating those. The US dollar remains a global reserve currency backed by Bitcoin. If they do, right? If the BRICS doesn't, then the Treasury, then the dollar remains the global reserve. It remains the global monetary system, right? So, but if the U.S. doesn't do it and BRICS does it, well, that's where the U.S. could get in trouble, because if Bitcoin becomes a means of exchange that's widely accepted and everybody's using it, and it becomes this natural reserve asset that people are looking for, that's anti-inflationary, while the Treasury is doing what we're watching is happening, people will start turning to Bitcoin. And I think they will start turning. And that's the event where you're talking about, well, that's when the dollar hyperinflates, because it's over. And it's not even the BRICS nations. It's just, that's it. That's hyperbitcoinization. The whole world. Forget about BRICS. That's the whole world, right? So, but I mean, that's a long way off. This is like wild, way out there stuff. But and you can bring up that chart if you want of the game theory.
But these things can happen quickly. I mean, if BRICS made an announcement in the next year or so, I mean, cooperate and defect, and cooperate is use Bitcoin and start accumulating it, and defect is you don't, right? You ignore it. So the thing is, if the U.S. cooperates if they cooperate, either way, it remains the reserve currency, right? Because they're going to back the U.S. dollar by Bitcoin.
if they defect and BRICS does it, and let's call it BRICS plus, and the rest of the world is using this currency, and they're actually really using it. Well, that is where hyperbitcoinization is a possibility. It's only when the U.S. refuses. Does that make sense? That's it. That's my take on it. Now, this is my theory, but the
other thing I don't understand is with the ability to print trillions of dollars, why wouldn't they be just accumulating a silent large position in Bitcoin? Why wouldn't any nation be doing that right now?
Because they're not psychopaths.
I think they are psychopaths.
No, in the good way, I meant.
Okay.
I mean, we live in a little bit of an echo chamber, right?
Yeah,
we live in a Bitcoin bubble. We talk to a lot of people who understand it. Go out and talk to anybody around here in London, and as I get home, I talk to them in Las Vegas. They're not thinking about this.
I know.
They're not even thinking about inflation. They're barely thinking. They're like, yeah, my grocery bill is way more than it was last year. That's about as far as they're getting.
I had Jeff Booth talking to Tom about it last night, and watching the conversation was fascinating.
What did Tom think?
Tom was like, because I said, look, just explain to Tom the scenario where we could hit high double-digit inflation. And Tom was saying back to Jeff, he's like, yeah, because like I understand we have inflation, but that's never going to happen. And Jeff was like, no, here are the steps. And I still think Tom was like, no.
Yeah.
You sound crazy, mate. You just want one of Pete's crazy Bitcoin friends. You want it to happen because you want your Bitcoin to go up.
Yeah, and let's make it clear. I don't want hyper Bitcoinization to happen overnight. That would be very painful for everybody.
Yeah.
That would be
awful.
That would be devastating.
Yeah.
Economically for the entire world. That would not be good. So no, this is a very slow process, and it's a long
gradually
and then suddenly.
Yeah, and there's a couple of interesting case studies we're going to get over the next year, I think. Sailors back in the green, which is fantastic.
That's awesome.
Because there are a lot of dicks out there who I think we're laughing.
They're rooting for him to fail.
Yeah.
They're rooting for that company to go under. They're shorting it.
He was down $1 billion or so at one point, wasn't he?
I think more even.
Yeah.
And now he's in the green. I think his average purchase price is 28,000.
Yes, I think it's 29.
And what are we at 30 and a half?
Yeah.
Yeah.
The amount of Bitcoin he has, you're talking 140,000 Bitcoin. What's that? Times, God, I can't even do the math on that. If we're up $2,000, what's that? Is that 280 million he's up, or 2.8 billion? I think it's 280 million or so. But anyway, he's up, right? But he could be massively up soon.
Yeah.
And he's going to be like, I told you so. I invited you to my conference. I talked to you about, are you going to his conference next week?
I'm not.
Yeah.
No.
And then I think there's a higher average purchase price, but Bukele's going to hit the green at some point. And all the people rooting for him to fail, he's going to be, we were right.
They're right.
We solved our economy. We've.
This is just a very. If you just ride the peaks and valleys, and that's the thing is that people get scared because Bitcoin has these massive runs and drawdowns. But if you're not selling, you wait it out. The volatility is not a negative when the price is increasing over time. That volatility is actually a positive. That's the crazy part.
So we're gonna see you in Miami.
Absolutely. Yeah, I'm supposed to be speaking. I don't know who with or what about, but I'll be there.
So we'll see you in Miami. We'll see you maybe November.
Yeah.
For the F1.
Fingers
maybe.
crossed.
That would be fun.
Maybe.
That would be fun.
Hold on, didn't we agree the other night if Bitcoin was over 100,000, you and I would split a box?
We'll see what those boxes are cost.
They're going to be scary money. And we'll see you back here next year for another promotion celebration.
Let's do it.
Fingers crossed.
Absolutely.
James, thanks for coming over, man.
Yeah.
Appreciate you coming over, and it's been a good few days.
Yeah, it's been awesome. Congratulations on the win and moving. You're graduating up. You're getting promoted. That's awesome.
Yeah, man.
One step at a time.
Back to work tomorrow.
It's awesome. It was great fun. Thank you for having me, and I'm looking forward to the next time.
Thank you for coming.